Valentin, I was telling her that we were commenting on all these things because you're too eager to talk and I'm too eager to ask. So we were, with my co-anchor, talking about this non-farm payroll and the unemployment rate. You know, this time they surprised us. The non-farm payroll went up, but the unemployment, it went up better than expected, right?
Right.
And the unemployment rate went up too, instead of going down like last time. Was that a surprise to you?
Well, it is a bit of a surprise, but not if you look into the dynamics of how the unemployment rate is actually calculated. So you have the number defined of unemployed people divided by the total number of people in the labor force. And now, actually, the reason why the unemployment rate dropped so much is
and it comes from another survey. Let's indicate that too.
Yeah,
they both come from different surveys,
right.
Household versus business.
Well, actually, in that case, it's also dependent on the census. But if you take out disgruntled workers out of the unemployment rate, then you also take them out of the labor force. That's purely by definition, right? So, but the number of unemployed is always going to be lower than the number of people in the labor force. So if you take it out of the numerator and the divisor, naturally the number will go down. Now in this case, the only possible explanation is that actually a few disgruntled workers returned to the labor force and also returned to the pool of unemployed people, so it went up a bit. Or it could be people going out of retirement, going back to work, or people who finished their degree and are now back in the pool of unemployed. So it is a bit surprising, but then if you realize how the whole thing is calculated, then you will know that everything is possible. And that's also why I personally I'm skeptical about the NFP number itself, because it has a lot of statistical flaws, it has a lot of noise in it, has massive seasonal adjustment in it.
Thank you for saying seasonal adjustment. So we were expecting that because of the harsh weather.
Yeah.
And then I know you were in Germany, you had a great weather, you came here, and you're all confronted with this harsh weather, snowstorm, snowfall that we hadn't seen in the last 3 years. So I thought that was going to affect the non-farm, but you were not expecting that much?
Yeah, of course. I mean, basically the consensus expectations were very low because of the weather, and it does make sense. Obviously, if you look at New York, for example, everything becomes more difficult, so obviously economic activity is going to slow down. However, if you look at the last 10 years...
Thank you so much for bringing... We were talking about this before the broadcast too. And then you told me, let's talk about the long term.
Yeah, the long term.
Because everyone looks at the non-farm payroll on a monthly basis.
Yeah.
But where are we in terms of relative comparison, right? In terms of 10 years ago, a decade ago. Yeah. Where are we? So you're a talented reporter, business reporter. I'm so glad I have you right now, because you don't get to have Valentin Schmid all the time. So let's talk about that. How are we standing in terms of 10 years ago?
So first of all, to finish off the part about the seasonal adjustment, on average, in February, you had 1.5 million of jobs added due to seasonal adjustment, which, by the way, the BLS in their model, they never disclose how they do it exactly. So it's pretty much arbitrary. And so you have to imagine that there's 1.5 million jobs added because of seasonal adjustment, and then you still only come out with 175,000 plus. That's not exactly much. And then that's why I like to look at really long-term indicators that are very solid statistically, like the employment to population ratio, which is at multi-decades low. It's hovering around 60% of people working actually in this country. And that number is calculated on census data and of course the BLS data. And so we had multi-decade lows here. The labor force, we talked about it, is again at multi-decade lows. We have the weakest recovery in terms of employment of any recession we've had in the last 100 years. And that's the kind of things I like to look at. So the employment picture clearly isn't great, and this one 30,000 beat in expectations clearly won't make a dent in that.
So the picture is not so pink from where you're coming from in terms of the, the labor market.
Yeah.
When are we going to reach the labor market we want to?
That's a very good question. To be honest, I have no idea. What's clear, what's different from the 3 decades ago is that employing people here in this country has been as difficult as it has been never before because of all the regulation and added costs. So it's basically very hard to employ people.
Well, the stock market is reacting positively to this news. Is that realistic? Where are we in terms of stock valuations?
So the stock market is a different animal on its own. Of course, the short-term traders, they like to trade these news. They like to front-run them. So the futures are up a bit on the day. But if you look at, again, long-term valuations, like me as an individual investor or somebody planning for retirement, would I want to invest in this market? And there are 3 indicators that I personally follow that I find very good and reliable. One is the Shiller PE. You know, Robert Shiller, he came out in 2000, wrote this book called Irrational Exuberance, where he said this can't go on. I think back in the days that ratio was at 40, crazy. And now it's at 25. It's cheap at 10.
I think it was 43 and we're at 25. It's very cheap, yes.
No, it is cheap at 10.
Oh, cheap at 10,
yeah,
yes.
You would buy when 10 is a definite buy signal. So 25 obviously is not as crazy as the dot-com bubble, but it's still not exactly cheap. So that ratio predicts about a 1% return on equities annually for the next 10 years, which is very low. So then we have the GDP to stock market valuation ratio that Warren Buffett likes to use. That's at 117%, and that used to be around 50 in the 80s when it was a good time to buy stocks. And last but not least, we have Tobin's Q, which is the value of the assets of all the companies listed versus the stock market valuation. And that stands at a bit higher than 1, so that means that the equity is actually a bit worth more than the assets, but that is cheap at 0.3. So all these indicators suggest that for the long term, US equities aren't really cheap. So why do I want to buy them? And then I look at the near-term risks. What can actually happen, what is happening in Ukraine.
If we don't invest in the US equities, then where do we invest? Taking the Ukraine tension, geopolitical risks or crisis into consideration, taking the emerging markets and also China, just cooling down, slowing down into consideration, right?
Yes. So we have a couple of factors here. So we have the long term, the odds are stacked in our favor in terms of valuation. And then short term, we have the geopolitical risk from Ukraine. And I mean, if we look at, even if there's no war, if we just go through a default and then maybe Belarus gets dragged into it, they are not in great shape either. Then we have a scenario like in '98 with the Russian default that wasn't very great for stocks. And then we have China, which over the recent years has contributed actually the marginal growth and marginal aggregate demand actually for a lot of products from the United States and Australia. And they're clearly slowing down. All the official figures, which are not reliable, they are slowing. And they're conducting a lot of very crazy policy initiatives. Like recently they devalued the yuan to discourage speculative flows, but that could actually mean another inflationary shock to them where they actually want to cool the real estate bubble.
Yes.
So all of that really doesn't bode well for stocks, and I would.
Valentin, last 10 seconds my producers are telling me.
Yeah.
So when the whole picture is like this, what do we do?
Well, there's only one sector which is completely misunderstood, which is mutually hated, and which offers a lot of value, and that's the gold and gold mining sector.
Gold.
Yes.
We're going to have to talk about it. It's like episode 2 with Valentin Schmid. Our conversation ends here, but you have to come back.